Going on, Cashflow Hackers? It's Chris, Life 180, and I'm here with Bobby Samuelson from Life Product Review. We're going to get into all sorts of fun stuff, talking about infinite banking, talking about the current state of the IUL market, talking about like all this fun stuff. I'm sure we'll go off on a couple tangents, but if you don't know who Bobby is, I personally believe, and maybe I'm biased, but I personally believe he is pretty much the best mind in the business when it comes to like really breaking down product reviews and doing an unbiased assessment and analysis of all these different sales strategies and product reviews and all these different things. I'm a firm believer, anybody who is in this business trying to represent it and you have a responsibility to know your products that you're selling, to know the industry inside and out. And I just think that the Life Product Review blog that Bobby writes is the best resource on the internet for really understanding all the ins and outs of all this stuff. And so, yeah, Bobby, I just want to thank you because like, honestly, guys, like a lot of the stuff that I get, like I read a lot of his stuff and then I take my education, down further paths, but like you do so much awesomeness. I just want to thank you and
Thanks,
tell everybody, like, literally it's the best. What is it? $99 a month?
Yeah. $99 a month. Yeah.
Guys, it's the best. If you're in this business and you consider yourself a professional, and I have nothing to gain from this, right? Like I'm just telling you because the thing I stand to gain is that you'll be more educated and the industry will benefit from you being better at what you do. So, I would say go to Life Product Review and subscribe. So, Bobby, let's have some fun. So you did a blog, speaking of your blog, you did a blog about, well, I don't know, like 2 months ago now. And it was talking about the infinite banking concept and some of like the misleading components of it, some of the misunderstandings and kind of where it's right and where it's wrong or whatever. Can you kind of like maybe give a little summary of that and kind of what your thoughts are as a whole of the infinite banking concept right now? Like maybe what the problems are, some of the bad marketing, the good marketing, all the above.
Oh man. Yeah. First of all, thanks for all the kind words. And I'll say I thought about writing about infinite banking for a long time and specifically chose not to do it because I knew what a hot topic it was. And I know that you have a lot of subscribers who either, get mad at you because you don't fully endorse the infinite banking concept, but you do take parts of it. And so, you and I talked about it a little bit. But for me, it kind of got to a fever pitch where I had a lot of people starting to ask me, what do you think about infinite banking? So I did what I usually do if there's something that I feel like I'm not an expert in, but I've seen, I go call people who I think are experts. So talk to you a little bit, talk to a lot of other people. I watched like everything on the infinite banking concept website, read anything I could find on the internet, talked to a couple of product development folks and, underwriting folks at companies that take a lot of IBC business to kind of understand what they've seen, not just in terms of sales practices, but also in terms of admin for the policies, issues down the road with enforced contracts. So I felt like I did probably more research than usual into an article because I knew how controversial it was.
Totally.
And the other thing is, when I write an article, I'm trying to tell a story. And it's one thing to go out and just bash infinite banking or support it completely. And I don't think either of those with infinite banking are the right response. And so the way that I structured my article was really kind of saying, look, there's a core idea behind infinite banking that is absolutely sound. It makes total and complete sense. And then as you kind of step down and get further away from the core idea, that's where things get a little bit strange. And so, and that's what I saw in a lot of the material too. I'd watched the YouTube videos and the TikTok stuff and whatever. And it was very clear to me that they're all, there is a core of truth and a core of goodness in all this stuff, but then people kind of push it too far. So I'd say, let's forget the term infinite banking for a second and just talk about what it actually is, right? It's just taking loans from a life insurance policy. Loans are magical. I mean, loans are fantastic. You know how much they're going to cost. You don't have a bank that you're going to negotiate with, so you already know the terms of the loan before it happens. The cash is readily available. You can pay it back whenever you want to. It's not taxable. Policy loans are great, and policy loans in a lot of ways are magic. To me, where you kind of get into the IBC world is when people start thinking about using those loans on, I'll say, a more transactional basis. The idea behind policy loans is sort of a once in a while sort of thing. As you kind of move down the stack on IBC, it becomes a lot more than once in a while. It becomes more like a lifestyle thing. Be your own bank, And so I heard stories even from people saying that they would get agents who would tell clients they should, when they're doing a big celebratory dinner, they should take a loan from their policy to pay for the dinner. It's probably not what was really intended. And also insurance companies have a lot of trouble with the admin for that, right? If you're taking, I heard about one policy where there are 99 policy loan transactions in a month on one policy. It's like, it's too much.
Yeah.
So I think that's kind of, so I think there's goodness in the loan idea. And then the idea of like, well, maybe too many transactions, too much stuff, kind of abusing the system a little bit. Okay. But then where I think it actually gets really problematic is when people start talking about the idea of taking a loan and always have your money compounding for you in the policy. Now that is true. But what they also seem to not talk about is the fact that the loan interest also compounds.
If you don't pay it.
If you don't pay it. And so I've seen these graphs where it's like, you see the compounding policy values, and then you see the loan balance being built up and taken down and up and down, and there's not interest being shown on that. And so it creates this perception that the equity in the policy will always increase. The equity in the policy only increases if there's an arbitrage between the cost of the loan and the crediting rate on the policy. And that has been the case for the last 35 years because interest rates have been falling.
Yeah.
That may not be the case. And in some cases, for some companies, it is already not the case. It's flipped the other direction, right? And so if you as you kind of step down, you go, okay, so policy loans are good. Too many transactions, probably not good, but again, kind of neither here nor there. But this idea of taking loans and never having to pay for them and still building a growth in equity and always keep your money compounding, again, that works in some environments that will not work in other environments. And then the last step, the one that's probably most concerning to me, is infinite banking sort of working its way into indexed UL, because indexed UL really doesn't work for infinite banking at all because the cost of the loan compared to the credit is going to swing around like crazy. At least if you're borrowing money from a whole life policy, even if you have an inversion between the cost of the loan and the policy credits, you're going to at least be able to see it coming, and you'll be able to understand its little differences. With IUL, you're hitting caps, you're hitting floors. And if you don't build in a lot of buffer of equity in the contract, you may end up accidentally lapsing your policy and having a big phantom income tax bill. So IUL to me is fundamentally incompatible with IBC because it's too volatile. And if it is going to be compatible with IBC and you're going to make it work, you have to leave a lot of equity in the policy that cannot be loaned in order to make sure you can ride out the 2 or 3 years where things don't go in your favor. And so again, kind of looking down the stack, it's like you can't paint IBC with this broad brush of saying it's bad or it's good. There are really good elements to it. There's some really powerful, I think, financial kind of foundational stuff that works great with life insurance. But as you push it too far, as it starts to make claims of perpetual arbitrage and building equity and all these sorts of things, that's where it gets to be problematic, because that may be true in certain environments and for a certain period of times, but it is not always and forever true. And I think that's the way it's often positioned, and I don't think that's right.
Yeah, I just did a video on this, and actually the video was inspired by one of the blogs that I read from you. And in this, I because I'm a pretty visual guy, right? Like, so I got my board behind me, and I basically drew out like the fixed interest rate environment, right? And the federal funds rate in like 1980 kind of going on this nosedive through 2009, right? And then kind of leveling out. Yeah. And the bottom line is like dividend rates in the early 80s hit a crossover point where it became, you could earn positive arbitrage because dividend rates will chase the fixed market, right? They kind of like, they chase the tail. And so now what's happening is interest rates go up. There's the opposite. There's going to be this crossover point where they're going to chase them up, and positive arbitrage is almost going to be impossible at some point in time if rates keep going up. Is that a fair assessment?
Oh, absolutely. I mean, we are already there for some products and some companies where the loan rates are higher than what the policy. So it's already happening.
Yeah. Even with non-direct recognition companies.
Especially with non-direct recognition companies. Right? I mean, this is the other irony, right? Like, the thing about, so everybody loves non-direct recognition. It's one of the key things about IBC. And that works great in a falling rate environment. You do not want non-direct recognition in a rising rate environment because, to your point, it's going to flip upside down. You'd be better off with having direct recognition, where at least you know the cost of the loan and it's 25 basis points or 30 basis points or whatever. Yep. So non-direct recognition is a sword that cuts both ways. And it's cut one way for 35 years and it's about to cut the other way.
Yeah. And companies, I think, will pivot, and they're going to have to like make shit. I mean, they can change. I mean, there's companies that have changed, aren't there?
Yeah. There's no actuarial reason why you have to do one or the other. So for example, MassMutual offers both inside of its policies.
Yep.
There's no reason why other companies can't do that. That's a very logical approach.
Yep.
And, everybody goes for the non-direct recognition because it illustrated better, but now actually the direct recognition illustrates as well as that does, if not a little bit better right now. So
Yep.
yeah, so that's my issue with infinite banking. Again, not the concept. The concept makes total sense. It's this idea of perpetual arbitrage, constantly building equity, and now this percolation over in IUL, which is too volatile of a product.
And that's a huge one. There are literally hundreds of thousands of IUL agents out there right now talking about the fact that IUL is a better vehicle for infinite banking. And I mean, there are influencers that I battle with on a daily basis that will tell you you're stupid if you use whole life for infinite banking and not IUL. Like literally that bold. And so anyway, so
we've seen this. Hey, look, we've seen this movie before. And what always happens is we get a few 0 years and those policies start blowing up. And this happened pre-financial crisis too. People were doing the same thing with IUL and it doesn't work.
Yeah. No, that's awesome. So, all right, let's pivot a little bit. Talk about, like, I read your article on the updates. You're calling it AG49B potentially, like whatever the updates to AG49A. I mean, I think you're like I said, I love your creativity and the way you kind of like create stories out of it all. But like, can you talk to me about like kind of like the current regulatory status and like the updates, what you kind of see happening in 2023 with updates to IUL, why it's happening, and so on and so forth?
Yeah, I mean, the quick story on it is we have these continual cycles in IUL where companies are coming out with other ways, new ways to kind of augment their illustrated performance. Regulators catch up, turn it off. Carriers come up with new ideas. Regulators catch up, turn it off. So we've been through this 3 times now. This one was pretty simple. Carriers were using non-S&P indexes with fixed interest bonuses to augment illustrated performance. And I think the key thing to know is that those strategies illustrate better and will actually perform worse in the real world. So if you have an S&P strategy at 6 and you have an engineered index at 6, but it's got a fixed interest bonus that pushes it up to 7, okay, in the real world, that 7% actually is not going to be 6. It's going to be something like 5.5 or 5.6 or something, but it illustrates at 7 because of this quirk in the model reg, or in AG49. And so that has now been fixed with these revisions to AG49A. That is going to be what I'm calling, AG49B. I can't imagine they're going to call it anything different, but maybe they will. And then it's going to be implemented, and it's got a couple more votes to go through. They're kind of perfunctory votes, and it's going to be implemented in May. And at that point, the S&P strategy in the product will basically be the best illustrating strategy, and we'll kind of revert back to what the intent was for AG49.
How is this update going to impact like all the proprietary index stuff that's happening?
Yeah, it's going to crush them. I mean, so if you're illustrating like the number one top, I call them engineered indexes, you illustrate the number one, right? Yeah. You can expect illustrated income out of that account to drop by like 50%.
Really?
Yeah. So for almost every one of those situations, the engineered index is now going to illustrate worse than the S&P because of the game. Yeah, because they were playing games with the option budgets,
which is great.
And so it's all going to unwind all this stuff. And so a lot of those strategies are just they're not going to illustrate. They're going to illustrate worse than the S&P. So the S&P will be the best illustrating option in the product post AG49B.
That's awesome. So I gotta go here. I gotta ask you a question. I didn't prep you on this. So I've been getting a lot of comments, right? Like with people, because I mean, you know how I am. I mean, I'm pretty bold. I'm pretty out there. I'm very whole life pro. I'm very anti-IUL based on my background and experience. And you're more agnostic, right? Like you're much, I would call it, less emotional than I am about it all, right? Like I just kind of, I feel like I have a responsibility in a way, because like, I feel like all of the illicit sales tactics being utilized by IUL agents, right?
Yeah.
They're doing this. And I feel like, because all these regulatory updates, I feel like eventually, if they don't get their crap together, there's going to be spillover into the whole life market, right? Like it's just going to impact all regulation. And so people keep coming at me being like, Chris, why do you have to attack IUL? Why can't you just focus on your own thing? And it's like, if you don't see that there's not a divide there, that they're actually kind of meshed together, and
they are.
And like, I feel a responsibility, even though I'm like the only one who's like really taking the heat to do it, like publicly. Like what are your thoughts? Like, I guess give me a little coaching for a second. Should I back down, or should I, like, am I being absurd? Like, you know what I mean? Or are all these other people out of a line?
Yeah, look, I used to be really emotional about this too. So I'm probably the wrong person to ask, but I do think I love the idea behind IUL. I
Yeah.
mean, the core concept of downside protection with upside potential
Yeah.
makes a lot of sense. I mean, and there is something really powerful about that intuition.
Yeah.
And I've said this publicly, like, and that's why I'm more agnostic, is I like the idea. I think there's merit to IUL. I think there's a real story for clients. On the flip side, though, I think there's a great story for whole life too. And to me, whole life and IUL share a lot in common, because with IUL, you're getting participation in equities through options. With whole life, you're getting participation in a mutual company because you're a participating policyholder. And so they're actually the two very similar products. And so you raise a really good point about spillover, because some of the things that have happened in IUL are actually also occurring in whole life, just on a smaller scale. So for example, illustrated loan arbitrage in IUL is actually less now than what we saw last year in whole life. So this illustrated loan arbitrage issue is the same in whole life, actually worse in whole life in some ways than it is in IUL. And I think IUL, writers are right to point out the fact that the same regulations that are happening for IUL should actually happen for whole life too, in terms of illustrated loan arbitrage. Another one is outside business earnings. Outside business earnings are a big piece of the puzzle for illustrated dividends in whole life. Outside business earnings are a little bit of a gray area in terms of how they should be illustrated or not. And I could see a scenario where IUL companies say, well, wait a second, if we can't show profits from options, whole life companies shouldn't be able to show profits from outside business earnings. Because the outside business earnings are basically the equity stake in the whole life product. The options are basically the equity stake in IUL. So I think you're right that these things are going to come together. And I think that will happen. I think there's an argument to be made that the illustration model regulation needs to be rethought. And in that scenario, you're going to see a little bit more, you're going to see some of these IUL issues kind of spill over into whole life. So I will say this, I think there's merit to the product. I think it's easy to get caught up in the bad apples. And everyone likes to say there's only a couple of bad apples in IUL. No, there are a lot of bad apples in IUL.
Yeah.
And it's not, and I'll defend them for a second. It's not their fault in some ways, because IUL companies make it so easy and defend it so, passionately.
Yes.
They defend these things that are ridiculous to anyone who is not in our business. And so people, I think, kind of get caught up in it. And, and they need a dose of realism. And look, I've been doing this for 15 years, trying to put some realism in IUL. You're doing it too. And what I found is the best approach is to say, look, there is dignity and goodness in the product, but that does not mean there's not ridiculous stuff that happens on the illustrations. And I think that is certainly true for IUL, but it is also more true for whole life than sometimes we'd like to admit. And we got to make sure we're not playing illustration games on either side of the house.
Well, especially I think that falls back, when we get into that on the whole life side, that especially happens with the non-direct recognition situation.
Oh, absolutely.
Because it allows or enables that to even
occur.
It
empowers it. Absolutely. I mean, I'd say 95% of the games I see being played in whole life illustrations fundamentally come back to non-direct recognition. And I don't think the carriers mean for that to happen necessarily, but it just in certain economic environments, it just does.
What are your thoughts on some of the indexing options for the dividend use in like One America, for instance, has an indexing option inside of the whole life platform? Like, what are your, to me, I looked at that, and when I was talking to them over there, I was like, man, this is everything IUL should be.
Yeah. So Guardian has it, Country Financial has it, One America has it. And there may be a couple more, but those are the big three ones. Yeah, I love that idea. I think it's great. I think it's a lot of sense. But I'll also say that is another spot where all three of those companies illustrate the maximum rate on their indexed account the same way as IUL. So a lot of times I'll end up in conversations with those companies where they're saying, oh, we have agents using this rider to win competitive cases by illustrating higher rates. Well, I'm like, you cannot bash IUL illustrations. Right. And do the same thing. You have to be consistent. So I speak at a lot of Guardian stuff and One America stuff. I'll get up and I'll say, look, these are not competitive illustration tools. They are real world benefits and options for clients, but they're not there just to win illustrations. So don't do that. Don't use them to win the illustration war. Run the illustration with a zero allocation to that so that you can avoid the games and sell on that basis, and then give the client the choice if they want to index their returns. Do not.
Yeah. Then you're truly giving them some upside, right? You're giving them some upside potential, right? When you do it.
Right. Exactly. Totally agree.
But
And
it's on
that's
the
the way it should be done.
agent to like really do your studying and understand what you're doing and learn how to sell it without just like selling based on the numbers on an illustration. Like
Paper. Yeah.
I think that's the biggest problem.
Well, and I think, look, you kind of brought it to this question you asked me that was not scripted, or you didn't
Yeah.
prep me for, but I think one of the outcomes of that is that, if we can't get an illustration model regulation that really works,
Yeah.
what we may get in the next round of illustrations may not look anything like the illustrations we have today. So imagine a scenario where for ULs, all you see is 2 or 3 years worth of a projection, and
Yeah.
then after that, you just see the policy charge schedule. That's it.
Mm.
I mean, that is a possible outcome, which would completely eliminate the ability for producers to use the illustration to sell the product.
And that would decimate IUL sales.
I hope not.
I believe it would, but
Well,
because I think it would decimate the sales field, the sales force, because there's a fraction of the people who sell IUL that are talented enough, educated enough, knowledgeable enough to actually go out and make that sale.
That's right, but they all should be.
They should be. Yeah. Oh yeah. It'll definitely elevate the
Yeah, the average will increase because the bottom falls out.
Yeah, for sure.
But I think that's right. I mean, if you're selling it the right way, you shouldn't need an illustration. And the best sellers I ever meet don't use illustrations to sell the product.
Yeah, but I talked to 2 agents that were good producers yesterday that called me that didn't even understand how IULs worked as far as the options budget, investing in options. Like they thought their money was just going right into the S&P index.
Oh my gosh, are you kidding me? Did that really happen?
Dude, 2 times.
I thought that's the kind of stuff. That's the kind of stuff I heard 10 years ago. I would have thought everyone by now. They are obviously not subscribers to the Life Product Review.
Obviously not. That's what I'm totally.
Obviously.
No, exactly. So, all right, well, let's move on here. What are your thoughts on this question? What do you see as a 3 to 5 year outlook for cap rates? Because, and let me elaborate a little bit. I'm getting a lot of questions, a lot of comments saying, hey, cap rates are going to go up. This is something that somebody that I'm in kind of a spat with right now about IULs. He's saying that his company is going to raise cap rates and that they can predictably do so because interest rates are going up. So the options budget's going to go up and all these things. What is kind of your perspective on how cap rates, par rates, spread charges, all these things are going to be impacted based on the increasing interest rate environment?
All right, I'm going to leave par and spread off to the side.
Okay.
You can't have a long-term perspective on par and spread because par and spread is so volatility dependent, and so that's a month-to-month sort of thing.
Okay.
Caps are a different animal. So I think in terms of sort of the core theory, here's what's going on. The price of a 10% cap in 2014 was 3.9%. That's how much it costs for a life insurance company to hedge a 10% cap, 3.9%. So to convert that, all a carrier has to earn on its assets is 3.9% in order to be able to offer a 10% cap. Today, like right now, the price of that option last week was 5.1%. So what's happening is, yes, interest rates are going up, but interest rates are an input into option prices. And so over the last year, interest rates have steadily marched up, and so have the price of options. And so has the price of options. And so therefore, that's why caps are kind of staying stable. So however, what we're starting to see is sort of a divergence, right? Some companies going this way and some companies. So if you think about it, in a falling rate environment, the best situation you can have as an insurance company is a big portfolio invested in old assets with low turnover. And that way you can hang on to your high yield assets for longer and keep your portfolio rate higher than your new money rates. In a scenario where new money is higher than portfolio rates, what you want is to be a company that's selling a lot of new business and has sold a lot of new business very recently, so that you have a small block that's getting a lot of new money coming in, and therefore your yield can rise faster with new money rates. So what we're seeing right now is a split in the marketplace where you've got a lot of established companies like Pac Life, for example, that sold a lot of business in 2014, 15, 16, 17 at much lower rates. They're keeping caps low. And then you're seeing companies like Allianz who are increasing their caps, who really didn't sell a lot of business until 3 or 4 years ago, 2, 3 years ago, small block, a lot of recurring premiums, a lot of new business coming in, and boom, you're getting them kind of catching up to more quickly to new money rates. So I think you're kind of seeing a little bit of a split in the market. I think if you were to make a generalization, I'd say I think caps are going to continue to stay pretty much where they are right now for any big established company. And if caps are high or increasing, it's because they are It's a smaller company with a smaller portfolio, and they're basically blending faster into new money. But I don't think, but here's the thing, right? That cuts again, both directions. So if rates come back down, right, that will burn off quickly. So there's just a lot of dynamics there. And I don't think, here's what I hear IUL people saying. I hear the same thing that I hear you. Rates go up, caps will go up. Only if option prices don't go up. And option prices have gone up. Option prices have gone up faster than carrier portfolio yields have gone up, which is why carriers dropped caps last year and dropped cap into this year. And so that's I'm sorry, 2022 and then into 2023, they're not increasing them.
Yeah.
So I just don't think you can generalize. Like every carrier is going to have kind of a different path. And so now if you stretch out 3 to 5 years, eventually those new money rates will come up. As long as option prices don't continue to go up, caps should go up a little bit, but we're talking about 25, 50 basis points. We're not talking about going back up to 12%. And I think that's the kind of gap everybody has in their head is, oh, it's going to go back up to 12. No, it's not. It's going to take a long time. It took a long time to come down. It's going to take a long time to come back up.
Well, so when you look at it, another kind of off the cuff question here, when you look at an IUL and let these companies that are illustrating at 6.5% assumed performance or whatever, what do you think is actually the realistic crediting rate going into a policy net of all fees, cost of insurance? Is it like 4.5, 5.5? Like, what do you see across the board?
When you illustrate 6, what you actually see in terms of rate of return in the policy?
Yeah. Like what's the good long-term? Because like, I get kind of annoyed with, agents being like, oh, you're buying this for the long-term. You got to think long-term, but then they only sell on the like 2 to 3 year window. Like this is what they're going to do today. No, let's look at the whole picture long-term. Like, what do you really see as a realistic?
I continue to say that I think over the long run, IUL is going to perform like a UL generally. And so corporate bond type returns. And right now, corporate bonds are pretty good, 5.5%. So I think if today's interest rate environment stays, 5% is probably good. But again, that's based on today's rate environment. So I tend to look at it as forget the look back, forget what the carrier is showing you, look at today's corporate bonds. And that's probably what it's going to be. Now, the yield curve's inverted, rates could come back down. So the main thing is don't worry so much about how it illustrates. Like, why are you even, whatever you illustrate is going to be wrong. We can all agree on that. And so the question is just how wrong do you want to be and in which direction? And the lower you set the illustrated rate for the sale, the more likely it is you're going to outperform. And that seems like a reasonable thing to do. But it doesn't sell well. And so people tend to go the other direction where they maximize it and then they give themselves all this situation, all these fact patterns that hurt the yield or hurt the rate. So I just say, look, I don't get why people are so worked up about this. Like, for my entire career, people have been asking me, what's the right illustrated rate for IUL? And there is no right illustrated rate. All illustrated rates are wrong.
Yep.
The question is just how you want to manage that risk. That's it.
Right. I always kind of say, like, use common sense. Like if the insurance company had the ability to get you 6.5% predictably safe, whatever, they'd figure out a way to do that for themselves.
Yeah. Right.
Right. I mean, like if you just break it down and eliminate all the noise, all the minutia, and just think commonsensically, like that's a pretty easy way to kind of look at it.
Well, yeah, there's some funny sort of technical elements to that argument, but I think that's a good kind of BS line to draw.
Yeah, exactly. That's kind of how. All right, so I get this question a lot, and I just love to hear your like 2-minute like rant on this. Like, a lot of agents are saying, Chris, why wouldn't an insurance company go out and try to get around regulatory things, try to make it so their illustrations will illustrate higher when they know they're not going to perform? These reputable, huge insurance companies who have the client's best interest at heart would never do a thing like this. Talk to me about that.
Whoever says that does not know the history of insurance regulation. I mean, if you look back to AG 38, which was the guideline to manage reserves for guaranteed UL policies, it was constant cat and mouse game of insurance companies hiding liabilities, trying to use tactics to reduce their reserves, and the regulators having to come in and update the regulation. AG 49 for IUL, the same thing. At the end of the day, insurance companies are not the moral arbiters of the universe. Like, I don't know why people put morality onto an insurance company. These companies are trying to sell stuff. They're trying to generally do things that they think are right, based on whatever metrics they want to see or they think at the time. whatever they can convince themselves, and they've got a lot of competing interests, and so they make the decisions that they make. They're not moral decisions or immoral decisions. None of this is moral or immoral. This is just trying to figure out how they want to position themselves and what tools they have available to do that. So I don't have any expectation that they wouldn't try to maximize their competitive position at every turn in general. And there are certainly some exceptions to that, but that's the way most companies kind of optimize.
Yeah.
So look, just because a company, and the other thing is, like, companies will believe their own stories. I mean, I worked at a big insurance company for years. We had lots of internal stories that we just kind of believed that may or may not actually have been true. And I think IUL is a great example of this. A lot of IUL companies, I remember years ago talking to an IUL company, and this company said, basically, we can't imagine a world where caps go below 10%. Okay, now that company's cap is 8%.
Yep.
So, and at the time they said we can't, and therefore we can't imagine an illustrated rate less than 6.5% that makes sense. Well, now they illustrate at 5.5%.
Yeah.
Or 5.25. So it's like, don't let insurance companies make your decisions for you.
Yeah.
Right? You as an agent need to make your own decisions and come to your own conclusions and decide what you think is fair and reasonable. Don't outsource that to an insurance company.
Yep.
They're not moral actors or immoral actors. Just you need to make that call for yourself.
Yep. Once again, use common sense in it.
Yeah. You know what? I should have just shut up and just said use common sense.
Much
better answer.
One of my mentors is a guy named Brendan Burchard. I don't know if you've ever heard of him, but he's like a high performance coach, whatever. And he always says, he goes, common sense is seldomly common practice. Right. Like, and so, welcome to America. Right.
Yeah.
So now this is going to be a pretty hot topic. We're running into this a lot. How do you see, what are you seeing in the world of the premium finance space? And how are the increasing interest rate environments and the loan costs and everything that go along with, like, what a lot of people have done with premium finance deals and what they're currently doing? Like, I know there's like this Kaizen product that's like a huge thing. I don't know if I haven't seen anything that you've done on Kaizen. Have you ever written anything up on Kaizen? No? Are you avoiding it intentionally? Okay. All right. So I'll leave that alone. But the, so what are you seeing just in the premium finance market in general?
I'm seeing right now, although this is starting to spool up, I'm seeing sort of what I call subprime premium financing coming under pressure. Okay. We've seen lawsuits, we've seen carriers pull back, we've seen all kinds of crazy stuff happen. What I would define as subprime is the existence of sort of two factors, maybe three factors. The existence of absurd promises at point of sale. So things like, this product will be free, or you will get X amount of income for life and never have to pay anything for, it's like so very absurd promises.
Yep.
That's kind of one factor. Second factor is no capacity or willingness to pay out of pocket or post collateral. All right. So if you put those two things together, that's what I would call subprime. And the third is a situation where that policy has been enforced long enough for the loan to be big enough that a big loan rate really matters. Yep. So you kind of have like 7 to 8 year old policies, again, sold as free insurance to clients who are probably not financially capable of actually posting collateral, paying interest.
Yep.
Those deals are really coming under a lot of pressure. But those three factors really need to be present. And if those three factors are not present, I'm not seeing a lot of big impact right now. Although I'll say every day I feel like I'm hearing more and more and more. In fact, I got a call a little while ago about a deal going south because of higher interest rates. So the subprime world to me is kind of 3 of 3. Okay. The one step up from that is maybe 2 of 3, and I'm seeing increasing evidence that those 2 of 3 type cases are coming under pressure. Okay. So it's like a securitized loan tranche, right? Like you've got the AAA stuff and you've got the toxic sludge, and the toxic sludge premium financing deals can't handle any strain. They're blowing up. And then it's, the problems are slowly working their way up the stack. And the longer rates stay high, and rates are very high for lending, 5% or whatever for 12 months over, the longer rates stay high. And if we get another 0 this year in the market, then that's going to be a problem. So that's going to be that I think, we will have to wait and see a little bit on premium financing. But
Yeah.
I'll say this too, and I talked to a lot of premium financing folks, and there is a little bit of an assumption that, hey, if we just kind of try to ride this out for a couple of years, things are going to go back to normal.
It'll get back.
And and we'll see. If they're right, but there's a good chance they're wrong. And if they're wrong and they haven't been talking to clients about it, and clients are getting collateral calls and they don't know what's going on, it's going to be a real problem.
Yeah, I mean the question, like how long and what's the burn look like to be able to get there, and it could be ugly. So last thing, because it's kind of on the premium finance side, but it's not really. It's like there are some people that have like kind of like utilized the IULs. Because is it fair to say that most premium finance deals this day and age are utilizing IULs?
Yeah,
most.
Yeah, 70%. Yeah, probably.
Yeah, exactly. So there's some people that are utilizing like kind of like self premium finance, like saying, hey, put your money in a policy, you can borrow against it, get positive arbitrage in the policy, get more insurance with that policy. And they're basically like utilizing the cash inside of the policy to do. Is the regulatory updates with AG 49B, so to speak, or like the updates to AG 49, is that going to have any impact on those kind of tactics and the illustrative ability with it?
Yeah, it'll tighten down the illustrated arbitrage. So those won't work the same. I mean, you may be able to get something out of it, but it's not going to work as powerfully as it does. Yeah.
Not looking as sexy. Okay.
You're talking about hyperfunding, where people are borrowing money from the policy and putting it back in as premium?
Yeah.
Okay, this has been going on since like 2005, and there have been all sorts of problems with these policies, and they blow up. Why people do this is like absolutely beyond me. But it still persists and it still exists, and I mean, it's just it's crazy to me.
It's nuts, but people are doing it, and it's like there's a couple people that have like popularized marketing tactics around doing it, and it's just like, it's gotten really popular. To me, it's super dangerous. It's like one of the most certain ways that you can take an IUL that has the potential of doing some good and making it almost nuclear as far as catastrophe goes for your
personal. It is exceedingly risky.
Yeah.
It's exceedingly risky. Yeah.
All right. Well, cool. Well, man, thank you for your time. We went a little longer than we thought we'd go. But guys, if you haven't, I know I started it, I'm going to end with it. Go to lifeproductreview.com and sign up. It'll be the best thing you do for your business. I you know what I've been doing, Bobby, recently too? People that call me and they're like, I'm doing all this IUL stuff. I'm thinking about getting an IUL. I'm like, listen, if you're going to put $20,000, $30,000, $40,000 a year into an IUL, go to Life Product Review, spend $99 and do your own. Like you're about to put your livelihood into this. You as a consumer, go learn about this before you do it, because you should never put your money into anything you don't understand. So if you're an agent and you're selling IUL, I encourage you to go like at least learn about what you're selling, so in good faith you can sell it and know what you're selling, right? If you're a consumer, go check it out, because you should never put your money into anything you don't understand. And there's not another resource on the planet that's going to give you a better breakdown than Life Product Review will. So dude, thanks for being here. Guys, go check it out. I'll put the link down in the description below. Feel free to email me, reach out with any questions that you have, and we'll go from there. So until next time, guys, have a blessed and inspirational day. We'll talk soon. See you.
Thanks, Chris.
Thanks, man.
All right, man. That was fun.